If you are getting a mortgage, one of the most important factors that you should be considering is what is my prepayment penalty when breaking this mortgage, if that does happen. This week on the Saskatchewan Real Estate Podcast, we're sitting down with mortgage wizard extraordinaire Matthew Imhoff as he explains prepayment penalties and what you as a borrower should watch out for. Hope you enjoy it.
This is the Saskatchewan Real Estate Podcast, the show that highlights Saskatchewan real estate. Looking to buy your first house, your next investment property? Subscribe to never miss an episode. Here's your host, Ron Quaroni.
Hello and welcome back to the Saskatchewan Real Estate Podcast, your home for all things Saskatchewan and all things real estate. If this is the type of content that you're looking for, make sure to like and subscribe to never miss our weekly episodes that come out every single Monday. One of the most important things that you're going to have to look at when getting a mortgage is what is my potential prepayment penalty when I'm taking out this mortgage. Today, super happy to have on mortgage broker Matthew Imhoff. He is an absolute mortgage wizard. We were talking before about penalties and lenders before this, Matt, and I'm just blown away by your level of knowledge on this. Probably you are the most top-level mortgage broker I've ever talked to who has such a deep understanding of prepayment penalties. So thank you so much for joining us on the podcast today.
Thank you for having me here today, Ron. Thank you.
Give me a little background on yourself, Matt. Introduce yourself to the folks who are watching or listening, and just your expertise on the subject of mortgages and prepayment penalties.
So I grew up in Winnipeg, so we're definitely rivals with you being in Saskatchewan, right? You know, Labor Day Classic, Banjo Bowl. I mean, it's nice that the Bombers are actually doing well now for a change. So got the blue on for the and you got the blue on for the Bombers too. So
that was not at all. Blue just goes well with my complexion. I have no affiliation with the Winnipeg Blue Bombers.
Okay, whatsoever. So I moved to Victoria with the Navy. I'm in the Naval Reserves, so I moved there, and then while I was finishing up sailing, I took my mortgage broker course, and I've been a mortgage broker. It'll be 8 years in September, so it feels like time's just flown by. My company is Meticulous Mortgages Mortgage Architects as a mortgage broker in BC. And then I'm also licensed as a mortgage salesperson in Manitoba, directly under Mortgage Architects.
Wonderful. Wonderful. Today, we're talking about prepayment penalties, those nasty things the bank will charge if you return the mortgage contract back to them. But give us an overview, Matt. What is a prepayment penalty?
So like you said, you're returning it. So it's the lender's return policy. So if we're talking about a closed term, right, in which they're expecting to earn a certain amount of interest over the course of the term based on the interest rates and the parameters that have been set, the idea is if you go and return it early, they want to make sure that they're compensated for that. So if you're returning it and the interest rate is very close to like what you're paying, then typically you'll pay 3 months interest penalty. If it turns out your interest rate is a lot higher than what they could actually lend the money out at, then that's where they'll charge you something known as an interest rate differential or an IRD. And that's where for there, that can be a lot harder for people to be able to visualize, because the lenders only really tell you what it is for that day when you request a penalty quote.
And that's the important part, is that if we're looking at a 3-month simple interest or an interest rate differential penalty, the interest rate differential penalty is a future penalty that we can't really know until we get there. But you, better than anyone, has been able to outline, what are the dangers that we're looking for. But break down why an IRD penalty can be kind of nasty. And we'll compare it to like banks and monoline lenders, or I believe monoline lenders don't like when we say monoline lenders, but basically mortgage companies that only deal with mortgages as opposed to one of the big 6 banks.
So the big thing is anytime you have a fixed rate mortgage, a fixed rate closed term mortgage, that's where they're calculating the interest rate differential, and they're calculating it whether you pay it or not. So like that's the big thing I try to tell people. They're calculating it whether it's zero, whether it's half of 3 months interest, whether it's a negative amount. They're calculating it. And if you look in the definition of what your prepayment penalty will be, it's the greater of 3 months interest or the interest rate differential. So the interest rate differential, if you break it down, if we look at it, if we simplify it, is really the interest rate difference, so the difference between your rate and what the lender can lend the funds out at. So let's say it's 5% is what you're paying. They come and they say we can only get 4%. From there, we can determine the interest rate difference of 5% minus 4% is 1%. Okay, so 1%. And then we're looking at how long your term is. So let's say you have 4 years left. We can estimate that 1% times 4 years is 4%. So your estimated penalty would be 4% of your balance. And that's where if that 4% of the balance is greater than 3 months interest, then that's where you're paying the interest rate differential. And so to imagine a 3-month interest penalty, in this case here, if your rate is 5%, 3 months interest is roughly 1.25%. Okay? Because it's 3 months out of 12, 25% of the year, times your rate, 1.25. So in that case here with this example, you would pay the higher, closer to 4% interest rate differential penalty because of how everything's calculated. And so the big thing I try to tell people is it comes down to the rate that the lender says that they can recoup on the money. So if they tell you that it's equal or greater than what you've borrowed the money at, you know your interest rate differential is either 0 or negative. And if it's 0 or negative, you're paying 3 months interest. And whereas if it's lower, then that's where you're trying to have to go and figure out, well, is it lower? Is it going to be big enough that it's greater than 3 months interest? Or if it drops further, that's where it can go up. And it's, people will break their mortgages for a wide variety of reasons. But when rates drop, they want to break their mortgage to get a lower rate. And if rates drop, that's where the interest rate differentials go up because the lender can only recoup so much. And that's what triggers the bigger penalties. So it's, yes, like right now, anyone breaking their mortgage for the most part is paying 3 months interest because they're returning money that the lender can go and lend out at a higher rate. But if things go and change, that's where it can quickly turn from 3 months interest to an interest rate differential. And we want to make sure consumers are aware of these risks and what they can do to mitigate and, working with a great mortgage broker like yourself to really plan it out and visualize it before it happens.
Let's elaborate on the difference between the big banks and the monoline lenders and how posted rates can make a big difference when we're making these calculations.
So we'll start out. So I like to go and say whether it's fantasy, whether it's real life or fantasy. So to quote Queen, is this the real life? Is this the fantasy? So for the monolines, typically they don't use posted rates. Okay, well, they'll call them posted rates. They'll call them reinvestment rates, but they don't use inflated posted rates in which they apply a discount to. So if let's say your rate's 5% with a monoline, it's 5%. They didn't take a discount off a posted rate. It's the contract rate. When they go and compare to their reinvestment rate or their posted rates, it's actual rates that they're offering for their mortgage product. So for a year in this case here, for them to go and say, we can only lend the money out at say 4%, they actually have to offer a 4-year fixed at 4%. If they don't, then they can't go and say we can only get 4%. Okay, so for there, they have less control in terms of adjusting things because it's something they actually have to offer. So if they wanted to say it's 2%, they have to offer a 4-year fix at 2%. And you look at it, we know roughly based on the bond yields, what they can offer. And they're not going to offer a 2% 4-year fixed if the bond yields are 3% or 4%. So at least we know that there's a bit more certainty and in fair play. With the banks, what they go and do is they go and apply a posted rate. So let's say the posted rate was 6%, and they give you a 1% discount in order to give you a 5% rate. So 6% minus 1% equals 5%. For that mortgage, you have to know what your interest rate is 5%, as well as the discount that you received off the posted rate. And that's where that can be forgotten because people are focused on, my rate's 5%, my payment's this, my balance, here's the interest, here's what everything's set up to be. But what happens is if we fast forward a year, they go and say, okay, we gave you 6%, 1% discount to get 5%. Our current 4-year posted, let's say it's 5%. Okay. If we take that 1% off, now it's 4%. Now they're comparing 5 to 4. But the idea is that they have more room that they can kind of manipulate things because maybe on their 5-year product, they're giving a 1% discount, But when they're selling their 4-year product, maybe they're giving 0.5% discount or a 0.2% discount. And what that can do is it can inflate a penalty far greater than what their actual losses are. And then you pay a bigger penalty. And so that's where the risk is, because they can manipulate this without necessarily offering a lower rate. Whereas with the monolines, if they want to say that the rate's 4%, they have to offer that product. Whereas, the bank might not be offering a 4-year fixed at 4%. So that's where they kind of get you. So it's just being able to compare apples to apples is to get it down to like, what's your rate and what are they comparing it to, versus like dealing with the discounts and the posted rates and everything.
So borrowers are clutching their hearts right now. They're gasping that, oh my goodness, how can I protect myself from these interest rate differential penalties? And what are we advising people to help them eliminate this risk of these big penalties?
Well, the big thing is don't break your mortgage, right? If you don't break your mortgage, then you aren't dealing with an interest rate differential penalty. So the greater the risk is the longer the term that you take. Because if you think about it, like we said, interest rate differential is interest rate difference times the years remaining. So you could have a long term with a small difference that gets you a big penalty, or you could have a short term with a big difference that gives you a big penalty. And so that's where the shorter the term, the less risk you have, because let's say someone gets a 1-year fixed and they're like, Matt, Ron, I'm worried if my penalty is going to be greater than 3 months interest. Well, you look at if 3 months interest is, let's say, 1.5% of the balance, that means your posted rate day one or the reinvest rate has to drop 1.5%. Right. And so you look at it over that horizon, is it going to drop 1.5% in 1 month? Probably not. And then let's say you're 6 months in. Well, now it has to drop, 3%. So it have to drop 3% from what it started at by month 6. And so you look at that, and even if it did, it triggered a bigger penalty, you're going to be happy that you're negotiating for your mortgage renewal in 6 months versus someone else who took a 3-year, took a 4-year, took a 5-year. So, in that case there, you might have it where the penalty is potentially creeping up, but no one's going to be upset if they're keeping their mortgage that, and it took a 1-year fix. If rates dropped rapidly, they're going to be happier that they're getting to that 4% or potentially 3% rate faster than anyone else, whereas everyone else would be dealing with a large penalty because the lenders have to adjust their reinvestment or their posted rates. Otherwise, everyone would return the 5% money, the 5.5% money, the 6% money. So it's just understanding like where you're at, and like, we were talking before, and like the roller coaster, like when can you get off? What are the best spots? Like if it breaks down, you don't want to be at the top of the hill, or like if it's one of those loop-de-loops, you don't want to be hanging from above, but maybe you're just mapping this out and just visualizing it. And it's, taking the time to really go through the scenarios can help you to know how to deal with, well, what happens if rates go up? What happens if rates stay where they are? What happens if rates drop? What are the positives from a longer term mortgage if rates go up? What are the positives of a shorter term mortgage if rates drop? Can I do something now, or do I have to wait until maturity to do something? And if brokers understand this, then really they can, really make sure that the clients are aware of what they need to do and when they need to do it. So they're not worried. And, every time that there's a rate announcement going up, going down, or bond yields, or, recession or economy or whatever, they're just aware of, it's almost like you can map this out for them day one. So they know, like, if this happens, maybe you'll reach out to them, maybe they reach out to you, but just really knowing what to expect before they get on the ride.
I want to add this into this, Matt, and see if you have an answer for me. We're sitting at the beginning of August. It's 2023. What are we saying right now when we're having the conversation between fixed and variable? And did you have a take right now as to whether or not we should start evaluating the variable rate again? Because basically we've kind of, for the large part, forgotten about it as rates have increased and the variable rate has gone quite high now. At what point do we start evaluating that variable rate, saying, when does this start to make sense again?
So, I mean, obviously the main thing is, can you qualify for the mortgage? Can you qualify for either a fixed or variable rate? Like, there's some people who it's one product they can qualify for, and it doesn't matter if they want variable or a 2-year fixed or a 3-year fixed. It's this one lender, this one product, take it or leave it. So let's assume that you can qualify for any products. Now, obviously, at the variable rate, in most cases, you're paying a higher interest rate than going with that 5-year, that 4-year, or that 3-year. But what you're getting is, hopefully, we don't see Bank of Canada raise rates further. Maybe they do. But when they start cutting rates, you're going to see your rate drop, 0.25, 0.5, 1%, maybe 1.5%. Also, if we're starting to see fixed rates come down, well, you have an opportunity. Well, maybe you lock into a 5-year fix at that point. It's like, if the options are, say, a 5-year fix at 5.5%, or that, let's say, 6.4%, 5-year variable, maybe part of the math is, hey, in 6 months, I think the 5-year fix is going to be 5%. And the math says go with the 5-year variable and then lock into a 5-year fixed, after a year. Or maybe the math says go with a 1-year fixed. And then it's really just about looking at all the different scenarios and, like, how do you win? How do you lose? And just making sure that you're not, going for that big win, but potentially having a big loss. Like, it's, at the end of the day, if we look at this, like, there's some people that have a variable rate right now that will lock in that it's the wrong decision. There's some people that have a variable rate that will lock in that it's the right decision. There's some people that have a variable rate that will lock in that if we fast forward 3, 4, 5 years, we're like, you paid exactly the same, whether you went with locked in with the fixed or stayed in your variable. But what did it buy you? Did it buy you that certainty? Did it buy you that, peace of mind? If you got that, then maybe it's worth it. But it's just, there's so many decisions. And, like, I look at it, if someone's really struggling, locking in might solve one problem in terms of rates not going up further. But what if you have to refinance in 6 months or a year, or break your mortgage or sell? That's where then now we're discussing that interest rate differential. And maybe you were so focused on your rate, you weren't looking at those dangers ahead when it came to that greater penalty. And then maybe you're wrong and rates drop a bit. And then now you have a bigger penalty and you're worse off than if you just stayed in your variable rate. So it's like 3D chess, on a roller coaster, right? So
tough to play 3D chess on a roller coaster. Just before we get to your contact details, Matt, everyone who comes on the podcast, I like to ask them this question. And it's always interesting to see what people have to say. But if you could go back and give young Matthew Imhoff some advice, what would that advice be?
So, I mean, I would say it's, there's times where I need to do a better job at, like, highlighting my value, both when it comes to clients, so, like, people who need a mortgage, as well as brokers that need help in the industry in order to understand penalties, to the level that I would expect, or that we would expect from mortgage professionals. So, I mean, even for things, it can be hard for me to ask for people to, write a review or, give some positive feedback, because it's like, I try not to make things about me, but if people don't know about what I can do and what I can share, then then people miss out, right? It's like I'm the best kept secret. And so I know for me, I wish earlier in my career I'd done a better job in terms of, if I do a good job for someone, taking that time and asking for a review, asking for introductions in order to expand my business, instead of having just, a bunch of really happy clients that, might not be reminded that, how I can grow my business. So I'd say that that's something there. And then maybe also, like, what you value in terms of being successful in this industry. Like, I find for new brokers, sometimes we're so focused on, like, the cheapest cost, like the lowest, broker monthly fee, and, like, the best splits. And it's 100% of zero is still zero. And really having it where, especially for new brokers, and with this being a difficult time, you really only have so long of a runway in order for your business to take flight. And so at the end of the day, you have to put yourself in the best possible position. And that could mean, finding that mentor, to work with, or finding the training products that help to, elevate you to the next level. And it comes down to it where, there's a saying, it's like, it's not what you know that gets you in trouble. It's what you don't know, that gets you in trouble. Like there's so much stuff here. And I always find it crazy when I talk to brokers and like, I didn't know that, or my broker owner didn't know that. And I'm like, how do you not know this? Like, is it willful ignorance? Is it just relying so much on the banks to like tell the client their penalties and everything? It's just, I look at this stuff too. And like, when I look at mortgages, one of the analogies I'll use is it's as if there's mortgage brokers who don't really understand mortgages, and you wouldn't hire an electrician who doesn't understand electricity. And when it comes to mortgage penalties, there are some brokers that say it's magic. It's a magical formula. And if you had an electrician that turned the light switch on and it lit up and said, it's magic, you would go and kill the breaker and call another electrician. Because at the end of the day, every electrician that's, good electrician understands what is going on when it comes to electricity. And it allows them to avoid situations where they make mistakes that could hurt or kill them, or hurt or kill someone else. And what worries me about brokers is like, this is the return policy. Like let's say we go to a Riders game, right? You take me to a Riders game and you're going to go and buy a jersey, right? Most people know more about the jersey return policy, than they do about the return policy on a mortgage that brokers are selling. And they're leaving it up to the banks to go and explain it. Well, the worst time to learn about how your penalty works is when you're paying that penalty, when you're breaking that mortgage. You want to learn about it before you even get it, so that you can make the best decision that saves you the most amount of money over the course of your term. So, lots of different things there, but it's, it's as long as we're learning, and it's never too late. And I've had experienced brokers reach out and be like, I didn't know that. And there's no such thing as a stupid question. Really, we just, if you don't understand something, try to understand it. Ask questions, like dig deep, because your clients are relying on you to know this stuff. And if you don't find it important, how are they going to find it important?
Wonderful. Yeah, I followed you along, Matt, for a long time. There are some mortgage broker Facebook pages that most mortgage brokers are a part of. And I've seen that you've been a super valuable member of all of those groups. And so even if from that side, there was that feeling that, like maybe I'm not appreciating myself enough, I can personally say that I appreciated your input and kind of what you're doing for the industry. I think is very honorable. And thanks so much for sharing so selflessly in so many ways. So much appreciated. If there is a mortgage broker out there, if there is a client out there who wants to connect with you, what is the best way to get a hold of you? How can people stay in touch? And if someone has a question, what's the best way to get in to reach out to you, Matt?
So I have my website. So it's meticulousmortgages.ca. And then for Facebook, you can find Meticulous Mortgages as well on Facebook. Google Business, you can Google. For brokers, we have our Facebook group, so Meticulous Brokers. So if you search Meticulous Brokers, you can request to join. And in there, I'm just posting just different things when it comes to like what I'm seeing when it comes to penalties or like recommendations. Because really what I'm trying to do is like map it out over the entire term and then adjust. Well, what if rates go up or rates go down? What if they make extra payments? What if they do a lump sum payment? And just kind of looking and being like, well, what are they committing to? Like, what is the danger in 1 year if nothing changes other than paying their mortgage on time? And if there's danger in a year at these elevated rates, there's going to be even more danger if rates drop 0.5% or 1% over the next year. Not to say that's a guarantee that's going to happen, but if someone's relying on getting off that roller coaster and we know it's not going to stop, well, they're in for a world of hurt, right? And it's just, as brokers, we want to make sure people are aware of, like, maybe if they're chasing that lower rate, they're not getting the most favorable terms when it comes to the prepayment penalties. And so that's just being aware of what you're dealing with. So, like, do I need to finish this entire term? Do I need to wait until the roller coaster stops? Or are there opportunities to jump somewhere else and potentially save some money? And that's where I think brokers, we really struggle to be able to explain that to clients. And if a client is really limited what they can do, it really needs to be something that's explained to that client before they commit to that product. Because that's where, for brokers, our due diligence to make sure they're aware of the restrictions of the product, because someone might love their rate if they think rates are just only going up. But most certainly, even if they assured you they're not going to break their mortgage, if they see rates starting with a 4, they're going to reach out. And if you didn't do a good job explaining that, well, rates are lower now, that penalty's even bigger, well, then they might feel that you sold them the wrong product, or didn't respond in a way to alert them of the dangers of that product. If they say they want to go with a particular lender, you almost just agreed with them. And it's, brokers advise, the clients direct, right? We give our recommendations, we lay out the pros and cons, and then the clients tell us what they want to do in the end.
Wonderful. So much value in there, Matt. Thank you so much for coming on and sharing your information. I really, really appreciate that. And I'll echo what I said before, that you're a credit to the mortgage broker industry in Canada. So hats off to you, sir. And thanks for joining us on the podcast today.
Hey, thanks for having me. And, I won't hold the fact that you're a Riders fan. I mean, I like that you're wearing the blue. So next time we're on here, you definitely have to wear some green. Okay.
I'm going to say this is Argos blue, because that's as close as I'll get to cheering to another team. But yeah, Argos go Riders. I really hope that our teams meet somewhere in the West semifinal, and I'll send you a message at that time.
Awesome. Sounds good. Hey, thanks for having me.
Take care, Matt. Hey, thanks for checking out this episode of the Saskatchewan Real Estate Podcast. If you found some value here, do us a favor, hit the like and subscribe button to never miss our weekly episodes that come out every single Monday. If you're in the process of buying a home, renewing your mortgage, or refinancing that mortgage, I am a fully licensed mortgage broker in Saskatchewan, and I would be more than happy to help you out with your next mortgage transaction. Until next week, I'm Ron Quaroni, your Saskatchewan mortgage professional. Bye for now.